You open the email, and there it is. You've been approved for a mortgage that feels like a lot of money, but that big number hides a dangerous gap between what the bank says you can buy and what you can actually afford to live with. Lenders design approvals to measure their own risk of loss. Your personal affordability is a separate calculation that determines how much breathing room you have left for everything other than the mortgage. This creates a frustrating dilemma for first-time buyers. You take that massive budget from a reputable lender, buy the house, and then wonder why you feel entirely financially squeezed trying to buy groceries. If you ignore the difference between these two numbers, you end up house poor. You technically own a valuable asset, but you lack the actual daily cash flow to maintain it or enjoy your life. To avoid that, we have to look past the bank's blind spots. We need a framework to calculate the honest math of homeownership. We are dealing with two different rulebooks. On the left, we have the lender math, gross income, PITI only, and the classic 28% rule. On the right is your reality math, but right now, that side is completely out of focus. The math is a zero-sum game. When you maximize the bank's theoretical approval limit, you automatically minimize the cash you have left to absorb life's surprises or save for your future. Relying solely on a bank's risk formula sets the ceiling of your purchase at the absolute edge of your financial capacity. The very first number a lender uses to calculate your affordability is your gross income. By using your income before taxes, the bank instantly inflates your perceived purchasing power by 25 to 30%. This chart shows a standard $100,000 gross income. But watch what happens when we remove federal and state taxes, healthcare premiums, and retirement contributions. You're left taking home closer to $70,000. The lender calculates your maximum house payment based on that full $100,000. That means you'll be forced to pay a very real monthly mortgage using ghost money, dollars that already went to the government or your insurance provider. Building a 30-year financial commitment on pre-tax income guarantees a permanent structural deficit in your daily household budget. Next, we have to look at the expenses the lender expects you to carry. They use a formula called PITI, principal, interest, taxes, and insurance. It covers the obvious basics, but PITI completely ignores the daily operational costs of keeping a physical property standing and functional. This chart tracks your true monthly burden. Start with base PITI. Add maintenance at 1 to 4% of home value yearly. Add utilities, $300 to $600 monthly. Over time, property taxes and insurance escalate. Finally, add HOA dues and special assessments. When you add all these blind spots together, the real cost of ownership runs 30 to 50% higher than the base mortgage payment the bank showed you. A theoretical $2,500 PITI payment that looks comfortable on paper quickly becomes a crushing $3,500 monthly burden in real life. A house deemed mathematically affordable based on PITI alone will actively and consistently drain your remaining cash reserves month after month. This brings us to the most famous golden rule of real estate. You should cap your housing payment at 28% of your gross income. Let's apply that theoretical rule to a realistic paycheck. Because of taxes and deductions, dedicating 28% of your gross income means you are actually spending closer to 40% of your net liquid cash on housing alone. That creates a severe squeeze. It suffocates your emergency savings, eliminates your family vacations, and leaves zero margin for the inevitable lifestyle creep. The honest alternative is strict. Cap your total, all-inclusive housing costs at 30 to 35% of your net take-home pay. The immediate financial trade-off is a painful one. Following this math means you have to accept a smaller or cheaper home today than the bank says you deserve. Sacrificing theoretical maximum square footage today is the direct, required price for securing long-term financial breathing room tomorrow. Beyond the monthly payment, we have to evaluate your financial resilience at the moment the deed is signed. Many buyers deplete all their liquid savings just to scrape together the down payment and cover the 2 to 5% needed for closing costs. Entering month 1 of your new home ownership with zero emergency financial buffer is incredibly dangerous because houses break. You also have to weigh the opportunity cost. Tying up massive amounts of capital in a down payment means that money isn't compounding in a stock portfolio or a high-yield savings account. To measure your true readiness, you have to stress test two variables: how long you plan to stay, and how deeply you rely on your current income. This chart maps those variables. If you are in this pulsing red quadrant, meaning you plan to move in a few years, and you require 2 incomes just to survive the mortgage, you are at peak financial fragility. If your financial model cannot survive a single broken HVAC system or a sudden 6-month job loss, you are not financially ready to buy, regardless of the size of your down payment. A housing budget that barely survives year 1 will inevitably collapse by year 5 due to tax and insurance escalations. To protect yourself, apply these specific action plans based on what kind of buyer you are. If you are a first-time buyer chasing approval, completely ignore the bank's maximum limit. Strictly enforce the 30 to 35% take-home rule, and make sure it includes all projected maintenance. If you are the safety-first, risk-averse buyer, prioritize your post-close emergency reserve above all else. Do not sign unless you have enough cash left over to survive a 6-month income loss. And if you are the wealth optimizer, rigorously weigh the opportunity cost and closing fees against the return on investment of simply renting, especially if your timeline is under 5 years. Now we can finally read that second rulebook. The reality math comes into focus. Calculate based on take-home pay, account for the total housing cost, and stick to the 35% net rule. The goal is to select a property your real-world income can support without straining the rest of your financial goals. Performing the honest math upfront is the only way to transform homeownership from a stressful monthly crisis back into an engine for long-term stability and wealth.